Hi guys, welcome to the Seven Money Show with me, your host Sean. If you find any of today's entertainment helpful, don't forget to smash the lovely like button. It helps with the YouTube algorithm and getting the video out to more people. If you haven't subscribed already, don't forget to hit the subscribe and bell notification. You'll be notified when a new video gets uploaded. If you're looking for a free trading platform in which to trade your stocks or shares, there's links in the description below where you get a free share for signing up. Now, on with the show. We're talking interest rates. People are worried about what's going to happen with interest rates. The Fed have said they're not going to go negative, and they're worried that it's going to rise. But the Fed has said that they're not going to rise until, they're not planning to make them rise until 2023. Not planning to touch them. Yeah, okay. That's fine for them saying it. However, the real thing that bothers me is if you're not raising interest rates, and no one likes interest rates to rise, you will end up with inflation and then hyperinflation if you leave it that way. We had the same thing when interest rates were zero in the UK. Inflation just kept growing and growing and growing and growing, and until they rose interest rates to bring it down. And in the end, either inflation will be at an unmanageable level, or interest rates will have to go up so high. The problem with inflation going up so high is once interest rates come down, some places capitalise on it. So you go to a shop, and because of inflation, something would cost, that used to cost $1 or £1 would cost $1.30. Inflation is brought down by high interest rates. Some unscrupulous places will still keep it at $1.25 and put it on sale at $1.25 when it should be coming down to $1 or £1. But anyway, this video isn't about that. It's about interest rates and GDP and debt. Japan, once they hit 1-to-1 debt to GDP, it wasn't long before they went to the current level, which is 2.5 times to 1. 2.5. Their debt was 2.5 times their GDP. Because once you go over what your GDP is, the debt so quickly mounts up. It's like a credit card. Now, before COVID-19 or the Rona for our friends across the pond, the debt to GDP was 50%. During all this, it was 80%, and now it's on a 1-to-1 level. Now, I said it's going to be more difficult to turn off the money printer than to turn it on, purely because if they do, that could cause a crash. Because people will think, oh, we don't have the security anymore. You have the Fed saying that they're going to take up 80 billion in treasury bonds a month, 40 billion in back loans a month, but whether they do or not is another thing. Really, the country can't have any more debt, because otherwise they're going to end up like Japan. Now, Japan have found creative ways around both hyperinflation and raising interest rates, but I don't think they're the same, that America can go down the same route. Another thing to look at is how the companies react to low interest rates. Now, companies traditionally take on large amount of debt. It's supposed to be to grow the company. However, what these companies do is they take on the debt so they can do share buybacks, because the CEO, his pay and bonus is based on the share price. If it goes up, his wages go up. So that's all he cares about, because he'll be moving on if he doesn't do a good job. I'll give you a perfect example. McDonald's. Look at that growth. This is when they started taking on debt to do share buybacks. We won't bother with when the Roni hit. We won't bother with the financial crisis. But you'll see how it was pretty flat. Not much growth, minimal growth. It was pretty flat from 2011 to 2015. And if you go into hold on a minute, let me get sorry about this, but they are basically using debt to do share buybacks, and you'll see here 2015 2011 flat, and then they started they announced share buybacks, jumps, and because of that growth, which is purely on the back of share buybacks, people are saying going to McDonald's is a stock you can hold for life. Well, no, because they have a rise in debt, and look at the debt to assets, 117%. And people weren't looking at the debt until now. And this is what we should be focusing on: companies' debts. Now, we have to look into the financials with every company now. We should be dissecting them. We should have been doing this before, but people were too greedy. And now the governments should be saying no share buybacks. I know they have said with the first round of stimulus, if they're going to help companies, there should be no share buybacks, but they should start saying to companies, no share buybacks unless your share price is at a low. That is why people like Elon Musk, I feel, do things the right way. They don't buy back when it's at a high. They buy it back. Well, they don't buy it back at all, because he feels the money is better used for growth. What he does is he releases shares on the market when they're at a high. I also think he will probably release more shares on the market soon, diluting shareholders. But one thing he doesn't do is take on debt purely to create share buybacks. And there's loads of huge companies like this. You know, you have Starbucks have huge debt, and people are saying buy Starbucks. When I said buy Starbucks, I said to buy it short term, to buy the dip, not for the long term gain. Anyway, don't forget to hit like and subscribe, and let me know in the comments below what you think. Do you agree or disagree? And I'll see you in the next video. Goodbye.